February is a crucial month. One more push up to get some more of this liquidity resting above here. However, you cannot trade guesses. You can only trade clear setups. I have an idea for a setup. I'm gonna talk about it in a little bit. Hello again, breakers, and welcome to our weekly update on the SPY and the question only up from here. Is this the start of the new bull run? People seem to think that the bear market is over, but where is their proof? I believe whoever is overly bullish might be in for a big surprise. If you've also watched last week's video where I was also talking about the correlation between the DXY, the dollar index that you can see here on the screen now, and the S&P, then you by now should have realized that really it is imperative that you also know the DXY even if you're not trading it. The right timing in trading simply is crucial. And what did we say? We entered a potential bounce area in the DXY, and indeed we ripped up. Why did we anticipate this potential bounce on the DXY? Well, we had entered the target box, the second bigger target box that you can identify way better and see way better on the weekly chart. Here it is. Also, we now finally tapped a weekly fair value gap and a daily fair value gap. So it was to be anticipated that there would be some reaction. And where did price head to? Well, straight into the fair value gap on the weekly, on the other side of the chart, basically. And with that, the question, of course, is what now? Will we really see a rejection in the SPY as we were hinting to last week? For that, let's go back to the chart of the S&P 500 and have a closer look at the higher time frame picture. Looking at the monthly chart, two things become quite obvious here. First of all, we are still in a clear downtrend, and this downtrend has not been broken yet. However, this is the February candle, and February might be able to do exactly that. Might be able to turn around the picture on the higher time frame on the monthly chart. So let's add our levels. If we look at the levels on the monthly chart, we see that this is the level 4,134.5 that we really want to break on a closing basis to say, yes, we are in an uptrend on the monthly chart again. At the moment, however, we have just entered an area of high resistance. Monthly liquidity above us and more monthly liquidity around 4,329. And who's to say that we can't rip up there and still reject in February to see more lows or new lows later on? You don't know. If we add our monthly target boxes, then we can see that we haven't just entered an area of monthly liquidity, but that price now also is within the first monthly target box, the one that you will end up with if you pull your fibs from this swing point, moving your fibs up to the absolute top. Then you see our second target box starts at around 4,312, which is very close to the liquidity zone that I was just talking about on the monthly chart. Concluding the analysis on the monthly chart, we can therefore say that yes, we are still in a downtrend, but February might be able to change this. Still, we are in an area of high resistance. This is not where you want to long for the long term. Definitely not. So let's move down to the weekly. Get rid of our monthly boxes for the moment, not to clutter our chart too much. However, at our weekly levels, and we see that the situation really doesn't get any better if we are looking at the weekly chart. Yes, we have confirmed this weekly uptrend by breaking through this weekly swing point level, which lies at around 3,974. But Also on the weekly chart, we haven't really broken the bigger downtrend yet, which we would only break once we close above 4,281 on a weekly basis. Finally, if we add our weekly target boxes and fair value gaps, we see that just like with the monthly, we are sitting right within a weekly resistance zone. There is a big weekly fair value gap starting at around 4,300 above us still. There is a tiny gap opening lying between 4,224 to 4,233 above us. A lot of liquidity, a lot of resistance above us. Concluding the analysis on the higher time frame, we can therefore say you can be cautiously optimistic. February is a crucial month. It might be able to turn around the weekly picture as well as the monthly picture. However, it hasn't done it yet. Adding one more component to the discussion, let's have a quick look at the fear and greed index for the S&P 500. It is within the extreme greed zone. This is really not where you want to long. Also, if you look at the timeline of the fear and greed index, you will see that whenever you are in these areas, you are supposed to rather consider shorting the market. Same goes for the areas of extreme fear. When did we bottom? End of September, 10th of October, just when we were right in the area of extreme fear. Now, however, we are at the opposite area of the chart. This is also something to consider. Zooming into the daily, my guess is that basically we will still see this one more push up to get some more of this liquidity resting above here before we see a bigger rejection. However, you cannot trade guesses, you can only trade clear setups. I have an idea for a setup, I'm gonna talk about it in a little bit, but it is not here yet. Before we move on to our midterm and short-term analysis of the S&P 500, what is your take on all of this? Is this the end of the bear market, or will recession catch up and let the markets still plummet to new lows? Comment below, let me know what you believe. Back to my guess, and with that, let's have a look at the more actionable midterm and short-term. Let me quickly get rid of our levels here and then zoom in a little bit on the daily chart. The daily, as we can see, is still in a strong and healthy uptrend. Let me add the daily levels to clarify that a bit more. As we can see, our current latest daily higher low resides at around 4,040. We have areas of liquidity underneath resting at around $4,000 and above us. The area we should be most interested in at the moment, 4,180 roughly. Obviously, we have already poked above it and have rejected. Now the question is this already the deviation before further downside, maybe even a trend shift on the daily if we break $4,040 or not? Personally, I still doubt it. I think there's a bit more upside to come. Let me explain why. If we add our areas of interest, we see that sitting at roughly around $4,220, we have a daily fair value gap. And I could just simply see us go for this fair value gap, poke through it, and then reject. So basically see us put in the high of the week, maybe on Tuesday, Wednesday, before we then reject for more downside. If we do that, where could this downside lead us to? As always, you want to mark out your target boxes on the daily. Then you see the lower target box starts at around $3,956. Very interesting. We have more confluence with a value gap on the daily here. And the same if you go for the more aggressive one, take your pick here from the latest leg up at around 4,030, especially the first more aggressive target box. looks quite interesting to me. Why? If we really assume that we put in the high of the week somewhere early next week and then reject, whichever way this may look like, we would end up in an area where we could, for example, wick below this level without closing it, so the daily uptrend would still be intact. We have more liquidity resting here. We are in a target box area, so many confluences before we then go further up again. To really be able to identify a trigger, of course, we want to go down to the 4-hour time frame. Let me zoom in a little bit here. Adjust the chart so we can work with it. And looking at the 4-hour time frame, we see that the picture doesn't really look too different from the daily chart. What we might still want to add level wise is this level at around $4,013. Mark it out as our current 4-hour higher low. And keep in mind that this is just another confluence factor for the area where we could see a potential pullback aim for, as we've described on the daily. Analyzing the daily chart, I've already mentioned that personally I doubt that we've seen the high already, and the 4-hour supports me in this view. Why? Because my cheat sheet still says no, the high is not in. What is my cheat sheet? My cheat sheet is the Bollinger Bands squeeze indicator. Go to indicators, type in Bollinger Bands squeeze, and then if you want to use mine, go for Bollinger Bands with squeeze by Nick the Majestic. Let me show you what I mean. If I put it on my chart, this is a squeeze. And what exactly is a squeeze and what does a squeeze do? It signals a period of low volatility before a breakout, which very often is basically a fake out. Just look at that last one. You see the breakout to the downside, which actually is a fake out because we see a lot more upside. And this is exactly what makes me doubt, for all the other reasons that I have already mentioned, we don't have a squeeze yet. However, if you go down to the 2-hour time frame, here you can see it form. So this is our squeeze, but how do we want to use it? What you do is you identify the latest high, which you have here, and then you anticipate price to squeeze deviate above it. And taking into consideration how much resistance we have above us, that we have a squeeze already on the 2-hour and that you find one as well on the 1-hour time frame, this is what you might be looking for to find a possible trigger for a short trade. If you are interested in more detailed information on how I enter most of my trades, then check out my video ICT Entry Techniques with a Twist, in which I explain how I use techniques and concepts of the inner circle trader and combine them with my own approaches and ideas to then gain entry triggers and signals from it. But in more general terms, the idea simply is that you get back inside of the, so to speak, squeeze range, and then you can take an aggressive short entry here. Or if you want to go for the more conservative approach, then best maybe on the 4-hour time frame, wait for a real trend shift, and then the pullback before you take the short entry to go, trade price further down. No matter which approach you take, understand that before we haven't closed below 4,013 at the moment, maybe a bit higher up, if we get the push on the 4-hour time frame, what you're doing is counter trend trading. So it really should only be considered a hedge to secure your gains from the long trade you might be in. If you like the way I analyze the charts, guys, then I'd be happy about a like and subscribe, because this really helps the channel. And always remember, don't despair if your entry hasn't come yet, or if you've missed it, it wasn't yours and your time is still to come to shine. See you next time, breakers. Bye bye.